Our moderator for this panel is someone you've already met. Please join me once again in welcoming member RICS South Asia Board and CEO Embassy Office Parks, Mr. Michael Holland, FR ICS. Our first panelist leads the India group with more than 19 years of experience in the real estate market. He is responsible for originating and executing real estate M&A, debt and equity capital markets transactions for Brookfield Financial India. Notable transactions that he has participated, among others, include the largest real estate deal due in India, which is the Brookfield acquaintance of Unitech Corporate Parks. Please welcome Mr. Pavan Swami, MRICS, Managing Partner, Brookfield Financial. Our next panelist has over 16 years of experience in corporate finance and consulting across a wide range of industries, while he has been focusing on real estate for the last 8 years. Prior to joining Indiabulls Asset Management, he was a managing director with JLL, where he was responsible for asset dispositions, sale and leasebacks, real estate financing, advisory on joint ventures, and capital raising. He was also responsible for special development initiatives and corporate advisory services. Here he is, Mr. Ambar Maheshwari, MRICS, CEO, Private Equity Funds, Indiabulls Asset Management Company Limited. Joining the panel now is the Managing Director, Consulting and Valuations for CBRE in India. He has over 17 years of experience and has worked closely with various industry stakeholders, including government authorities, developers, corporates, financial institutions, and has been personally involved in some of the most prestigious mandates in the post-liberalization era. Please welcome Mr. Rami Kaushal, MRICS, Managing Director, Consulting and Valuations, India, CBRE South Asia Private Limited. Joining the panel as our final member is a qualified architect from the School of Planning and Architecture, Delhi. He honed his real estate skills at CBRE whilst gaining valuable experience and proficiency in business development, project coordination, and client management for various investment advisory mandates as an associate director and regional head of the Strategic Consulting Group. During this tenure, he acquired an intimate knowledge and understanding of real estate credit risk management procedures. Please welcome Mr. Gulzars Malhotra, MRICS Partner and COO, IPAL Fund Managers. I now hand the floor over to Mr. Holland, who will take us through the next 45 minutes.
Okay, so we got 42 minutes, and welcome back. I was just thinking, I am a really lucky guy. I've been fortunate throughout my career. One of my big lucky breaks was that when I was a young buck at JLL in Singapore in the mid-90s, when India wasn't so popular and wasn't on everybody's mind, that the senior partners there at JLL said, here's some young guy. Okay, that we need to find out about India. And I put my hand up. And that was a big lucky break for me. And many of you that I know from many years have known that I've been knocking around India since the late 90s. In the more recent times, I've had some great business opportunities in India. And today my luck is in as well, because we have what must be one of the best panels that one can have about people who really know about this market. I've worked with many of the members of this panel. I've known them for many years. I think we're missing one member. Are you going to join us, Aditya? Aditya is with a large institutional investor from the Middle East. So our panel comprising people who are involved in advisory, in fund management, in valuations, development, and institutional investors. So we are, we're really in for a treat. We've said that we're going to have a discussion that is open and fluid. We're going to look forward to questions. We're going to get a lot of different perspectives. Generally, I think there was a sentiment from the opening session of optimism, perhaps with some reservations about lessons learnt from the past. This session, we want to explore which are the asset classes that investors and developers are or should be looking at. We want to look at the short term and the medium term. How long is this spirit of optimism going to continue? We want to address the question about, are we heading for a real estate bubble? And perhaps what actions we might take to address that. So without further ado, the trend that we're going to follow is we're going to look at the three big investor sector classes. We're going to start with residential. We'll talk around the office market and space, which is a large sector. And then we're going to explore some of the newer sectors, including industrial and other segments that an institution or a developer might be looking at. And once we've gone through all of that, we'll try to wrap it up with where is the market at, are we in a bubble, and so on. But I just want to, before I open the discussion with Amber, I want to prove to you my admiration of some of the people on this panel. In my briefcase this morning, I was carrying around a couple of market reports. Often I'm asked by journalists, I run a large office park portfolio, I'm often asked by journalists about the state of the market and data in the market. And I am of the view that although the business I'm responsible for is one of the largest office portfolios in the country and has two fantastic shareholders, that actually we have a limited perspective, limited to the markets that we're operating in and the sectors we're operating in. So I often say to journalists, I recommend to them research reports that are done. And this morning I was carrying around the Brookfield quarterly market report in my briefcase. And I was also carrying around the CBRE market report in my briefcase. And I also took the JLL study that was issued this morning and put it in my briefcase. So I'm fortunate that all those companies are represented either by alumni or individuals, and that they'll comment on that. So I want to open up the discussion with Amber, and Amber is now running a fund, managing a fund, but has seen the market from a broader context. I want to ask you, Amber, about your views on the comments that Mr. Hiranandani was making around the residential sector and the future that you see of that from an investor perspective.
Sure, yeah. So just before that, I think you really played it safe. You know, every research report from everybody, the likelihood of someone or the other landing in your panel was very high. But so yeah, you know, taking a cue from what Mr. Hiranandani said, I think I'm as well a firm believer of residential as an asset class for this country. You know, for the next 15 years, at least, given the demography that we have in this country, you know, 10 years ago we used to say 500 million people below the age of 25. Now we are saying 500 million people below the age of 35. All of these guys are going to go out and buy houses over the next 15 years. There's a significant amount of shortage as far as residential is concerned in this country. And therefore, in my view, I think I'm completely in sync with Mr. Hiranandani, not just for 5 years. I'm sticking out my neck and saying 15 years as well. Currently, the situation may be a bit of a challenge, so which is likely to continue, you know, every odd year now and then over the course of next 15 years. But from a longer term perspective, if you look at it, I believe residential is something which nobody can go wrong. You know, so that's really my view.
And Pavan, you were making some comments earlier on about where you think the residential market is in the cycle, particularly in Bombay, I think you were talking about.
So I agree with Amber and Mr. Hiranandani. I think the only concern is the pace at which we'll grow. Really, I don't think I have any doubts about the fundamental demand that is actually there in the country. Over the last couple of years, just to throw a few numbers, new launches for residential have come down by about 50%, which is a pretty significant number. And sales velocity or sales volumes actually come down by 24%. Am I really worried about some of those statistics? I don't think so. I think the markets will improve, just simply because there's fundamental demand. The market is pretty open and it'll find its water. I don't think we're in a situation where there's. I think I hear a lot of people saying there's a lot of supply in certain markets. Maybe in certain markets, but on an overall basis, I don't think. I think there's a lot of capital that is available to build out. I think a lot of developers still need to focus on execution, and as that happens, the velocities will come back.
All right. So speaking of developers, Gulzar, would you like to comment on that? And maybe explain a little bit about what your business is and what you do. So you're at the coalface with the customer, I think.
Okay. Just to give a perspective of what I'm doing, which is what I was telling Mike before we started the session as well, is that I'm not too sure these days which side to sit on, whether it's the investor side or the developer side. Considering I'm handling both aspects of it, we have a real estate fund, which we're currently in the process of deploying. And we are also handling a development company with about, close to about 35 million square feet of space, either under construction or in the pipeline. Getting back to the topic at hand, yes, I completely agree in terms of, the fundamental demand for residential in the country. Couple of key challenges that have, emerged over the last few years. In my opinion, one of the biggest things has been the categorization itself. Most of the reports, and including the reports that Mike is referring to, we have this historical categorization of, the tier 1 and tier 2 cities. And I've never really figured as to what is it that really derives, whether, can you categorize a city as tier 1 across segments? Can you categorize a city as tier 1 in residential just because it consumes or absorbs the maximum amount of commercial space? I'm not too sure, because that's something that skews investor perspective when they're looking at certain markets. In my opinion, I don't think at this point in time there is any other tier 1 city as far as residential goes apart from Mumbai. I know that's not going to be too favorable with a lot of people, but I have reasons for it. If you look at the city itself, the city has sustained certain price levels which are way above every other market in the country. As we speak, the prices in the city, despite being at historical lows, are probably double of its closest competitor. I'm looking at key areas of the city. In terms of absorption, and I was again, going through the report that Mike was referring to, I think there was about 16.5 or 17,000 units that Mumbai absorbed as opposed to any other cities. It was the highest, with Bangalore coming in, I think, second at about 11 or 12,000 units. The key difference being the price point at which these units were absorbed. There's a stark difference in the two. The other parameter that I gauge or that I look at to actually identify the tier that should be allocated is the difference between the prices of ready projects vis-a-vis the prices that we really look at in the, the projects that are getting launched. I don't think there's any other city where the variation between completed projects and under construction projects varies from anywhere between 30 to 45%. So that's the level of catch-up that the residential segment in Mumbai still has to go in terms of price itself. And also in terms of the demand, there is a significant amount of demand that's sitting on the sidelines. We've seen certain amount of that coming into the market over the last 5 to 6 months. We've had 3 or 4 big launches which have been pretty positive. And I think things will change, but yes, developers need to step in and execute capability and, demonstrate capability.
So Adi, are you also of the view that Bombay is the only tier 1 city from an investor perspective in the country, in the residential segment?
Not necessarily. I think there's other cities in the country. I think there's other asset classes outside of residential, though I will agree that residential is just by far the deepest asset class in the country. So if you're allocating money, then resi normally gets the most. But I'd also argue that India is a little unique. Markets are shallow. Investable stock for any asset class is shallow. So if you've got a certain amount of money and you're allocating it, if you're ahead of your competitors, you'll get the right opportunity and the right partners, and there's very few good partners. And if you fall behind, then you may have as much money as you want, but you can't deploy it in a manner that you think appropriate. And that goes across for office or retail or hotels or resi or any other asset class you might want.
Right. Yeah. I think I've observed that this issue that as soon as there's a spike in investor interest, there seems to be a shortage of product in the market. A number of players all chasing the same product. Before we go off the resi topic, Rami, any observations around that? What are you seeing in terms of your advisory work, your valuation on the resi? Who's interested in it? Is it a key part of the investor portfolio?
See, residential still remains a hot favorite sector, though it's facing some headwinds in terms of demand slowdown, etc., and inventory build-up. But it still remains a sector which a lot of investors are considering. I think the only change that we're seeing is rather than they going after futuristic projects, where new infrastructure will come up, then this micro market will develop, etc. They're looking at projects which are immediately monetizable. And also what's happening is, though various research reports will tell you about inventory pile-up, doom and doom, demand slowing down, etc. But if you were to go city by city and look at some of the statistics, so there has been demand compression. Let's say particular cities dropped by 30%, some cities have dropped by 20%, etc. But I think what now investors are looking at is whatever balance absorption is happening in the market, whether it's 50% left or 60%, where is that happening? And I have to align my investment in project with that. I think that's a change which we're seeing. So they're not relying on an economic event happening or infrastructure being developed and then, I will monetize my assets. So they're looking at something which is more near-term, more immediate. So that's a change which we're seeing. And significantly from our standpoint still, 40 to 50% of our work, flows from residential still, and even in today's market.
Yeah. So I just want to pick up on a point that Amber made when we were speaking earlier on. About that rate of demand, that expectation of capital value appreciation in the residential sector, and how that impacts buyer behavior.
Sure, yeah. So Mike, today there is a bit of a challenge in terms of demand, predominantly, in my view, driven by investment demand by individuals. This is at an individual level rather than an institutional level. Typically, buying a house is a very traumatic decision in this country, and it's not like equity where you could buy today, sell today, and so forth. Typically, an individual would go out and buy an apartment, particularly for investment purposes, only when he believes that the pricing is going to move up tomorrow, and if he does not take the decision to buy today, he just may miss the bus. Today, the scenario is nobody in the country is of the view that the pricing is going to go up tomorrow. That sentiment has to come back. The only way that sentiment can come back is when the economy goes up on a high growth path, higher growth path compared to where we are today, where disposable incomes increase and so on and so forth. In my view, I think, not very, very far from now, the developers will start to, to look at increasing prices. That's the only thing that induces investment demand, investment dollars that go into real estate, into residential apartments. If you look at the residential yields, residential rental yields are 2% or below. So nobody looks at buying an investment asset in residential class for a rental yield. People buy it for capital appreciation. And I think the moment that sentiment comes back into the market, that if I do not make the decision to buy today, I will miss the bus. That's the time when I think the residential demand will go back up to the levels that we saw earlier.
Right, so we're perhaps in a lag phase while those end users, end purchasers are waiting for that to come up, and we've got this big gap between supply and potential demand.
I think so. I think it is a matter of time. I think it's just a matter of time. The moment people start to feel a little better about India as a growth story and so forth, it's going to come back again. I have no doubt in my mind.
And in discussion over coffee, we were agreeing on this concept that perhaps for the next 10 to 15 years, the overall trend is positive, and that there will certainly be times, which is perfectly normal in any international market, when there's peaks and troughs. Our business is a cyclical business. But the trend, my sentiment, and I think we agree, is that it's on the rise. Moving perhaps, thanks Amber, moving on to the commercial office market, and I'll bundle the IT and commercial markets together. I would be interested if anyone wants to comment on whether there's a differentiation in terms of attraction from investment. We've seen, quite a solid 2 or 3 years in that market, perhaps since 2011 in terms of demand. The stats that were issued last year about absorption ranged from, I think, 38 million was a typical figure that I saw, 40 million, and I saw a headline just today that another consulting organization had even talked about 50 million square feet. So it's a very solid, in the calendar year last year. So it's a very solid demand going into that market. So again, thinking about institutional investors, one of our shareholders has interests in approximately 50 million square feet of offices across 20 different business parks and properties across the country. There's clearly an interest in that market. Pavan's group also have been in acquisition mode in the commercial office market. The challenge that we see in South India is a challenge. My boss in London years ago would have called it a high-class problem. We've got a 97% occupancy across a 24 million square foot portfolio. So our challenge is different challenges to the lack of demand. But there is a big difference from the numbers that I've seen in Brookfield's report, big differences between supply, vacancy, and the size of the markets in terms of demand between north and south, between Delhi, Bombay, mixed with, if you compare that with Bangalore and Pune, I think the vacancy in the south is equivalent to between 1 and 3/4 for those cities, whereas it's counted in terms of years in the northern markets. Pavan, perhaps you could comment on the institutional interest in the commercial sector and where you see that as part of an overall portfolio for an investor.
Sure. So there's if you look at the interest from the institutional community on the office sector, there's really two different. I'd like to analyze it in two different pieces. One is a bunch of investors who want to buy core, by which I mean income-producing real estate assets in the country, and then institutions that are looking at putting money as equity to build out office. And if you look at the core, really there's a lot of interest. There's taking names. You've got Ascendas, you've got Blackstone, you've got Brookfield. You've got a whole bunch of institutions that are going out and crowding to buy income-producing real estate. GIC, I missed out. Bunch of names there. And all of these are actually overcrowding the market. There is only that much built-up supply that's there in the market. I think the government's done its bit to relax FDI and increase that whatever smaller combination of all the assets that are there in the commercial space and not just IT or SEZs. But if you look at the office build-out space, where are we at right now? Really, the markets are back. The absorption levels are back. Vacancies are down. Office leasing has made a pretty strong comeback. People need to start making more offices again. People are beginning to start making a lot more offices again. But if you look at the return expectations when money has to go in at an equity level, it's people are looking at money which is north of 22, 23%. And if you look at building out an SEZ, there's almost a cap on the amount of rental income that you can get. I mean, it makes sense for outsourcing firms to pay $1 a square foot a month, and it's a pretty it's an advantage that the rupee is depreciating to the dollar, and therefore that number goes up to 65, 70 rupees a square foot a month. Now, if you capitalize that at a 9% yield, it gives you a certain capital value for the building. Now the issue is the amount of the cost of construction and the land acquisition cost is pretty significant. So the amount of margin that's left for the investor coming in is pretty tiny. And I believe that there will be a lot of interest from investors trying to going ahead and investing in not just IT and SEZ, but non-IT and SEZ as well. Of course, the demand for that is fairly limited, but I do see that coming up as well. So I think on an overall basis, there is an overcrowding in the market. There is a lot of investors out there. And it's an amazingly comfortable asset class for a global institutional investor to get in, because there's no development risk, you know, there's a building up there. It's easy to assume a compression in the yields. So it's just an easier asset class for a global investor to get comfortable with.
Adi, you're in that category. Do you agree?
I want to just go back to something that Amber said. I'm sorry. Just keep in mind, all of us are in the room, and there are a very limited number of people. There's hundreds of millions of Indians who think capital values in Resi are not going up, and yet all of us smart people are still putting money into Resi in the hope that they're going to go up. So either we are supposedly super smarter than hundreds of million, or maybe we're doing it wrong all over again.
So when we wrap up, that's our bubble conversation.
I'm just saying, see, I think it depends on investor appetite. There's a certain set of investors with a certain risk appetite and a return requirement, a return preference who will go for development. There's a certain set of investors who are more comfortable without development risk. And I think I'm going to be crude and simplistic. Folks who have global investors who have offices in India are, I presume, on a go-forward basis, far more comfortable with development in terms of their ability to monitor or oversee the risk inherent in their investments. Folks who don't necessarily have on-ground presence might not be as comfortable with development risk in India. As regards IT versus non-IT, I think you're going to understand core globally, Mike, you know this, and a lot of you guys know this, core globally is corporate office. It's not IT. Yokohama, for example, has got far more, maybe about 400 million square feet of office space, which is just data banks and IT, and it's not core. So India is, we make our own definitions, and what we call core may or may not be core for the rest of the world. But that's okay, as long as it works, it's fine. But I think core is not what we call core. And therefore, your appetite that you expect as an Indian developer or owner of assets in terms of foreign investors coming in might be different than what their expectations are. That's okay.
Yeah. I mean, I'd like to just make an observation on that, because that, in our portfolio, we often have to overcome, I believe it's overcome that perception that our portfolio is primarily an ITES portfolio. We talk about our portfolio having a foundation that is technology. So that might be hardware or software. That might be the Cisco's or the Cisco's or Microsoft's or Google's of this world as a foundation. But then on top of that, we talk about 6 different sectors of aerospace, automotive, retail. It's all facilitated by IT, but it really is different segments. E-commerce is another sector. Pharma and healthcare is another sector. So I debate that point about, core, in my view, doesn't necessarily mean that it has to be a downtown banking center. Let's say an Express Towers would be considered to be core in many parts of the world, that type of building. But the business park type of environment, I think, also can be part of that core piece of the portfolio.
Completely agree. But keep in mind, the capital that you're trying to attract will view what you have perhaps not as core until you're able to explain to them that you should view it as core. And it's a tough fight.
Yeah, and the guy with the money makes the calls.
I'll just put one more, make another observation there. If you look at the city of Mumbai, for instance, Adi, your point of IT not being core, most of the IT parks in Mumbai are not occupied by IT guys. Right? And there you go about your own definitions of core versus not core. So,
sorry to belabor this point, but understand the pricing that you expect is different, and foreigners need to understand it. And maybe it all helps all of us who are motivated with higher capital values to be able to explain it or differentiate it better, so that somebody coming in can actually understand it may be an ITES use, but look at the tenant profile and please treat it as core and please price it as core.
All right. So we could talk about this big segment of the market at length. Rami from CBRE was mentioning earlier on that I think 70% of your valuation work is coming from the investor side. So you've got a perspective on what investors are looking at. Office is clearly a big part of that. You mentioned that townships or mixed-use developments are also part of it. What other segments and sectors are you seeing that there's an interest in from domestic and international investors, apart from the core office, IT, resi?
Just to before we get into the newer sectors that are emerging, just a point on the office sector. See, what we've seen is post the financial crisis, a lot of projects which were planned or supply in the pipeline got shelved, and there were not too many launches. Like, Pawan was mentioning a number on the residential launches going down. Office also saw something similar, 2009, 2010, where a lot of projects were shelved because of lack of, uncertainty, lack of availability of capital intensity of these projects, etc. So what we are seeing now building up in the market is over the next 2 years, we're going to be undersupplied actually, right? So which now basically brings us to the point now, since, like you mentioned, your portfolio is 97% occupied. A lot of people are thinking on those lines. So which basically means, given the next 2 to 3 years, a lot more launches and a lot more stock built up. So what is happening in the market also, whether it's residential, whether it's office, is your cycles are becoming a lot shorter. So we were used to a 10-year cycle earlier. Now it's like 3 to 4 years. You have the peaks and the dips in that kind of a 3 to 4 year time frame. So I think from an investment standpoint, whether you're evaluating office, especially greenfield or brownfield, one needs to have that 5-year outlook. That's typical, standard time which it takes to bring a project from ground up to marketing level. That okay, what is the scenario 5 year down? So I think there might be still supply building up in certain pockets, though we are undersupplied as we speak. From a transaction standpoint. Also, talking about some of the newer things that investors are evaluating. From especially on the consulting side of the business, that gives us a very good flavor of what people are thinking, because that's where the workflow comes from. But I think definitely the flavor of the season from our standpoint is industrial and logistics. While residential, office, retail continue to be strong, there's regular activity happening there. People are evaluating, launching, etc. But I think logistics and industrial is what people are trying to understand better, trying to evaluate what the investment opportunities are. These segments have their own challenges, but that's something which is on everybody's radar as we speak.
Right. Amber, you manage money. Is that a segment that you've put some interest towards?
I think it's very early days, Mike, but having said that, I think there is no doubt in my mind. I think logistics and warehousing is pretty much where office was in the year 2001, 2002, if you like. Obviously, huge amount of impetus through the retail segment that we look at today. If you look at between Amazon, Flipkart, Myntra, and Snapdeal put together, all of these guys, as on date, occupy over 6 million square feet of warehousing space in this country. And this has happened over the last 2.5 years. And that's the reason why Rami is seeing a whole lot of interest in this particular segment, because this segment is now starting to pick up in a big way. Already, a whole lot of owner-occupiers are coming through in effect, and which is when the third-party speculative development sort of starts up. And I think now is the time to start thinking about this particular space, taking a cue from what Mr. Moneybags here was talking about. You got to be ahead of the curve. You got to be ahead of the competition of competing capital, and I think which is the reason why a whole lot of people have started talking about logistics and warehousing, because now is the time to start thinking about it. In a year and a half, 2 years time frame, I think there will be a huge number of developers with bankable projects where you could go out and put money to work too.
Yeah. So I'd like to ask any member of the panel, we've seen over the last decade this rush to, for example, retail, the rush to luxury housing, the rush to affordable housing, the rush to different segments. And most of them, in our experience, there's been a little bit of pain after a few years. Is that going to be the case in this industrial logistics, warehousing type of sector? Are we going to see some pain in 2 or 3 years' time in this?
You see, essentially talking from the investment standpoint and the demand standpoint, when you talk about logistics, addressable market like we call it, what a developer could get into and construct warehouses and start leasing or light manufacturing, as we speak is around 600 million square feet. That's what we're talking about. Top 30 developers on warehousing just constitute 6% of this. It's a very, very fragmented market. So there's definitely an opportunity for a player to come in and put a structure around this. So that's one observation. Also what happens is this is an extremely price sensitive market. Let's say if I'm a grade A developer developing warehouses, am I getting a premium like it happens in some of the office developments, whether it's Bombay, Bangalore, etc.? Answer is practically no. So your premiums could be as low as 3 to 5%. That's all we're talking. So it's a cost game. So in terms of opportunities, so the opportunities are more on the development side. Aggregating land is a problem, getting approvals is an issue, etc. So the opportunities are more on development rather than pure play financial, stake in, projects which are already existing, etc. And the addressable universe in terms of the number of projects available to invest is very, very limited.
Right.
So that's why you see a lot of development platforms being created by financial institutions and developers getting together and trying to address this market.
Right. I think that goes back to Adi's point about how shallow market, and also that this sector is not, apart from the land component, is not such a capital intensive sector, right? So maybe it's not for the large scale institutional investor, simply because to reach that scale will be difficult. That sound fair, Pavan?
I just have a very simple point of view, and this is if you wear a developer's hat. If I've got finite amount of money, where am I going to make maximum amount of return? Effectively, if office is going to be doing well, like everyone has agreed, if residential demand is going to come back and it's going to be there, and I know that, there's always been this demand for warehousing industrial. It's not just come up over the last couple of years. It's been there for the last 4 or 5 years. It does not make sense for a grade A developer, or it did not at that point in time make sense for a developer. It's a game about volumes. So the amount of money that a global institutional investor will have to put in to own it'll just be so much square footage to manage and stuff that it might be harder for him to agree to the point that you made. But I think it's also about the amount of return that you can make. You've got to get ahead of the curve and invest in a market that hasn't taken off. But there's definitely demand there. How quickly it'll grow. My sense is you'll see a different category of developers that will focus on this and really succeed on it, rather than the traditional larger developers playing residential, office, and retail.
Right.
Also just to add to that, why this sector is in prominence. I'm not talking about industrial, that's Make in India, and etc. All those initiatives are going on. See, on logistics, what is happening is fundamentally there are 2 or 3 changes happening. The biggest of them being GST. So when you speak to these occupiers, and they've always been occupying warehouses, we understand that, and the journey from 1PL to 4PL to 5PL, everybody understands that. But what's happening is with the GST coming in, there will be a lot of consolidation in this industry. So now, what one could do is, and it's an opportunity for development. So let's say if there's a HUL or a pharma company or a e-commerce company, whether it's Amazon, Flipkart, etc. Let's say if there are 2 products available, one backed by a good grade developer, one with a local landlord, more or less similar priced, where am I going? Right? So it's that opportunity which has brought this sector into prominence, because we'll see a lot of consolidation once GST is approved. And that's why everybody's talking about it.
Great. We've got 6.5 minutes left, so I'd like to throw it out to other classes as well. But Gulzar, is there scope in a portfolio for retail nowadays, for healthcare, any other classes?
I just want to take a step back to the point that you raised about different asset classes being the flavor of the season, as we've seen over the years, and how that's really changed, and whether logistics would again be the same. What we've really seen in India is that we somehow expect India to reach the top end of the curve without going through the pain.
Yeah.
Right? That's not going to happen. Let's face it. It's never going to happen that every segment evolves the way it is globally reached and we don't go through our cycles. Whether it is the commercial space, whether it was software technology parks, IT parks, SEZs, or it was the township bandwagon or the hospitality bandwagon, I think logistics will see its share of challenges as far as development goes. There would be newer issues that come up once we actually step into this because, challenges can come in from any side, whether it is regulatory, whether it is taxation, whether it is actual development, demand, capital. But at the end of the day, we need to also understand that India is heading towards an economy where people will eventually, or investors will eventually start segregating their portfolio and having investments in varied classes. As a pure investor, I don't just put all my money into one stock unless I'm a Warren Buffett and I know exactly what that stock's going to do. I still diversify, right? And that goes from my objective with the capital. So that stems from what Pawan was just saying. If I have the money, will I put it in logistics? Well, I may allocate a part of it because I want to have a certain amount of return from a particular money, and I may allocate the remaining to a safer asset class. So I think that differentiation will happen over a period of time.
Right. Different classes.
If I can just, make a point on that logistics side as well. When I got into real estate, Mike, we used to say office is a very, very fragmented market, very, very large number of players, smaller guys, this, that, and the other, and challenges, and how do you build a million square feet of office space, right? That's where logistics is today.
Yep.
If history is any indication to how future is going to be, look at what's happened in the office space. That's exactly what I believe logistics is going to go through. So, your question on whether we are seeing that pain that, everybody goes into a herd mentality. India is a very commoditized market, shallow market, and so forth, more than a large number of people. So I don't think a 2-3 year time frame, 5-year time frame is the time frame for pain in this industry. I think office started seeing pain, 7 years from the time that Ascendas probably came up with an IT park.
Yep.
And so forth. So I think there is a time frame, there is a long amount of time frame that logistics will have to go through before it can start seeing pain. In my view, what ITES did for office, e-commerce will do for logistics.
Yeah.
From a tenancy perspective and occupancy perspective and so forth.
Yeah, that's a great, I think that's a great soundbite. I'd just we've probably got time for only one question. If there's a question from anybody in the audience, we'll take that. And while somebody might be thinking about doing that, any comments about the other segments? The hotel segments, does that play a part in a portfolio that you'd be looking at? I think.
So I'll take a shot at it. We were talking about at Coffee, capital has become selective. So selectively, I think capital is available for all kinds of asset classes. There is a Sami Hotel space out of Delhi, which is attracting a significant amount of capital, only hospitality. Goldman Sachs did a platform deal with Nitesh on retail, right? So office, residential, all kinds of things are happening. There is capital available. There is capital available for all kinds of asset classes. It's just that over time, it's become far more selective compared to what it used to be, and which is a great thing, which is a good thing. It's a normal thing to have happened in the evolution of Indian real estate industry in a shape and form that we've gotten to at this stage.
Yeah.
So yeah.
I would agree. Adi, closing comment. We got 2 minutes.
I think we've been talking about portfolio diversification. To Ambar's point, barring the large global private equity guys like your shareholder and maybe 1 or 2 other guys, almost all other capital that's targeting India or other asset classes is very selective. Its asset classes are predetermined. So, and a couple of sovereigns or pensions. Almost everybody, when you guys, on the limited inflow of information we get from GPs, and there's potential GPs out here as well, when you go out to raise money, you're already saying, I'm going to deploy in this particular asset class, in this particular strategy, in this particular theme. So it's not so much portfolio diversification. It's now portfolio diversification for us is theoretical, and for all of us sitting on this table. You've already made your bet. So to Ambar's point, I think if you as a fundraiser, as a GP, and as a developer, you're pretty much going out saying, I want to raise money on residential, on office, either stabilized or development, and then you go and find the right capital provider for that particular theme or strategy. And I don't think there's too many global investors who are looking at India and saying, I want a perfectly diversified portfolio within India. I think for them, diversification of portfolio is a much more global macro and above my pay grade, for sure.
Right,
Concept.
looking at that diversification across
India,
regions and the globe.
India itself is a diversification of their larger global portfolio.
Right. And so, as a closing question to you, I won't use the moniker that Amber used, but because you are one of the largest global institutional investors, or you represent them, how's the sentiment today compared with where you might have been 3 or 4 or 5 years ago?
For India?
Yeah.
Positive.
Positive.
For sure, it's positive. But that doesn't mean money is going to just... No, not from my perspective.
No, of course.
We've always, Pawan pointed out earlier, go look at foreign investors coming in India in 2006, 7, 8. Very few made money. If they'd made money right now, you would have seen 10 times the amount of money flowing into India. They didn't.
Right.
All of us have got this second chance. If we don't make money this second time around, then we can all go home and find new jobs in new sectors.
I think that's a great... Go on, Pavan.
Sorry, and I think that is that, you know, it's not the debate about industrial and office, but I do think, and this is my personal view, I do think people are underestimating the size of what the office market will be in 5, 10 years from now. I think once the growth comes back, there's going to be a lot more office getting built out and absorbed much before it's gotten built out. We'll get back to that phase. So I still think that, you know, there's a lot of progress possible there.
Yeah, I think we'll close on those positive notes. A few key takeaways I would say that were mentioned repeatedly is, you know, our market is going through a consolidation in different sectors. It's concentrating perhaps in some of those sectors with larger players at all levels. Investors, developers, and end consumers are a lot more savvy than they were 7, 8 years ago, and so we're seeing much more selective decisions and much more knowledgeable decisions. But the key takeaway, I think, is the optimism that's expressed, I think, universally by this panel. Not short-term optimism, just short-term optimism, but for the medium and long term. And that's a great place for us all to be. So thank you, gentlemen.